Okay, it's 7 o'clock. Good evening, everyone. This is Yang Wang, a reference librarian from Greenwich Library. Welcome to our online program on planning for a financially secured retirement. Before we start, please allow me to give a brief introduction of the speaker today, Dr. Henry Mamaysky. Dr. Henry Mamaysky is a partner at Home Street Capital, which offers its client model and market analytics, wealth management, and investing service through separately managed account. Henry is also a professor at the Columbia Business School, where he is the director of the program for financial studies. Henry's research focuses on the application of quantitative techniques to investing and financial planning. Henry is a frequent industry and academic speaker. Prior to Columbia, Henry spent years in finance practice, rising to senior portfolio manager at Citigroup and later serving on the firm's risk executive committee. Henry was a professor at the Yale School of Management, which he joined after earning his PhD in finance from the Massachusetts Institute of Technology. He holds BS and MS degree in computer science and a BA in economics from Brown University. Now let me turn the screen to Dr. Mamaysky. Thank you.
Great. Thank you very much for that introduction. Hi, everyone. Good evening. I'm going to share my screen. Let's see. That is our first technological hurdle in the presentation. Okay. All right, so I hope everyone can see that. I see my chat box here, so if anyone has any questions as I'm talking, please type them into chat. I'll try to address them in real time, and hopefully we'll have a little bit of time at the end if there are some residual questions. So as the gracious introduction noted, I wear two hats a little bit. I work at a firm called Quant Street Capital, and we are an investment advisor working with institutional and retail individual clients. And in addition to that, I'm a professor at Columbia Business School, where I teach finance and do research on quantitative investment strategies. Let me just mention, if you'd like to receive some of the materials we put out for our clients at Quant Street, you can click on this link or just type it into your browser, bit.ly/QuantStreet, and sign up for our mailing list. And if you're interested in some of the things that I'll be talking about, we put out a lot of content like this, throughout the year. So let me tell you a little bit about myself. Oh, but before that, let me just read through this disclaimer. Investing in financial markets involves risks, as you all know. Investors may lose money, and no investment strategy, ours included, can ensure a profit or protect against loss. So the presentation that I'm going to do today is all about education. It's not specifically investment advice for anyone, because I don't know enough about your personal circumstances to give you investment advice. So this is just educational content. So a little bit about myself. I started off as an academic. I worked at the Yale School of Management. And then my colleagues at Yale were gracious enough to give me a one-year leave of absence because I wanted to go and work in the investing world and sort of see what that was like. So I took a year leave of absence and I went to work at Morgan Stanley in an investing group there. And that one-year leave of absence turned out to be much longer than a year. It lasted for 13 or 14 years, depending on how you count. I was at Morgan Stanley, then I was at a hedge fund called Old Lane, and then I was at Citigroup, always kind of working with the same group of people who went from one institution to the other to the other. I returned to academia almost, not quite, but almost 10 years ago. So I rejoined at Columbia Business School. And in addition to what I do at Columbia, a few years ago, together with my brother, actually, we started this firm called Quant Street Capital, and we're an investment advisor, and we have a quantitative kind of investment approach that we try to help our clients invest their wealth with. So let me now jump into the presentation with those pleasantries taken care of. So here is a typical investing and savings timeline. So this is, you can think of this curve as something that represents a person's wealth. When people typically start working, so this will be like year zero of our calculation, they don't have a lot of money often. So, their wealth is fairly low. As they work, they accumulate money. And in terms of the time horizon here, you can probably think of it in terms of years. You start working when you're in your 20s, maybe in your early 30s, and then you work until you're 50, 60, 70, and then people retire. So you can think about the typical sort of savings timeline as consisting of two phases. The first phase is the accumulation phase. Sorry, I'm trying to, right. So you can think of the savings sort of curve as consisting of two steps. One is, what happens as you're working, and the other one, what happens when you actually retire. When you retire, you stop saving. That's basically this point here. That's kind of the inflection point in your savings curve. At that point, you start living off of your savings, and several things can happen there, which we'll talk about. And in terms of planning for how much you save and how much you will spend when you retire, it's most useful to think of it in terms of two sort of two regimes, two kind of investment decisions or investment saving decisions that you can make. So the first of those is you need to figure out, kind of starting at the end, how much will you need when you actually retire. So we're going to do a thought experiment today. Let's visualize our retirement, which happens in either 5 years or 10 years, or maybe you're already retired. And we're going to think through how much you need to spend, and then how much savings do you need to have in order to finance your spending if it happens to be in excess of a pension that you may be receiving or your Social Security income. Once you figured out how much you need to have to spend when you retire, how much you need to have saved when you retire, you can think about how to get to that point from today. So we're going to think about this as sort of starting backwards, like starting at the point when you retire. We're going to ask questions like, how much will you be spending? How much savings is needed in order to finance the spending that you'll be doing? How should your savings be invested? How much risk should you be taking? Should you be all in bonds? Should you be all in cash? Should you be partially invested in stocks? And another important question when you are in sort of the retirement phase of your life cycle is, are you going to be depleting your savings or maintaining your savings as you go along? And we'll sort of talk about that margin of decision making as well. So we're going to first talk about what you do kind of at the retirement phase. And having figured out what you do at the retirement phase, we're going to think about, well, what should you be doing if you're not retired? What should you be doing now? So we're going to talk next, kind of second in our presentation, about actually what chronologically would come first, which is the accumulation phase of your savings timeline. And that is when you figure out what you need to have at retirement, how much you need to be saving now in order to achieve the savings goal that you have set for yourself when you retire. And the other dimension of that question is going to be, how much should you be investing? And how should you be investing? Like, what should be the asset mix of your investments? Again, stocks, bonds, et cetera, maybe other investment products, in order to, with some comfort, and I'll explain what I mean by with some comfort, get to your desired wealth level when you actually retire. So the way we're going to do today's talk is we're going to first talk about the decumulation phase. So like, imagine you're retired. How much will you be spending? How much savings do you need? Having figured that out in a little bit of a toy example, we're going to think about, if you're not yet retired, how much should you be saving and how should you be investing in order to get to that the accumulation phase, and to make sure that you have enough assets and resources that you'll be doing well and as expected when the retirement time comes around. So the first part of our discussion today is to figure out how much you'll need in retirement. And luckily, this is a well-studied question. There's a lot of resources available to help you think through these things. So I'm going to share some of the, high-level observations with you, and also give you some reading material at the end that hopefully will give you more guidance and more places where you can learn if you want to study this question a little bit more. And by the way, if you want access to these slides, there's a link here at the bottom, which is pointing you to our website, the page called Presentations. You can download this presentation from our website. If you'd like to have a copy of this presentation, you can just email me, and I'll give you my email address at the end, and then I'm happy to send you a copy of the PDF file. So when we start thinking about the decumulation phase, so this is the retirement phase, you have to think of that in several stages. And the first stage of that is when you finally stop saving, how much will you need to spend? And in retirement, people typically spend less than they spend when they're working. And actually, there's some amount of empirical studies that help us think, well, how much less do people actually spend when they retire compared to what they were spending when they were working? So let me just show you some of those insights. So typically, you can think of there as being several categories of spending that will occur, when you retire, that may differ from what you're doing when you are still working. So typically, when you look at the spending that people will have on housing, on taxes, and how much people need to put away as savings, because when people retire, they're no longer saving. All of these expenditures will be lower than they were when people were working. Typically, things that are stable relative to when people were working are things like food expenses, entertainment, transportation costs, like car or, travel to visit friends and family who may not live near you. So those expenses tend to be stable. And unfortunately, the one category that tends to have higher expenditure when people retire is healthcare. So there are several links here, which I won't click on now, but if you click on these links, one is from Fidelity, one is from Vanguard. They provide calculators where you can basically type in your expenses across different categories, and their calculator will help you sort of do a projection of how much are you likely to spend when you retire, given what your spending plans are today. And that might be useful exercises for folks to do who are sort of thinking about retirement planning, not yet retired. The typical rule of thumb that the industry has come up with is that you will spend somewhere between 55 to 80% of your pre-retirement, pre-tax income when you actually are in retirement. So this number is something called the replacement ratio. It basically says how much of your pre-retirement income do you have to replace with either Social Security or pension or savings, expenditure from savings when you actually retire. So there's a rule of thumb with regard to the replacement ratio. So I'm showing you here a chart that comes from a report that Fidelity put out back in 2019, which basically shows you that the more affluent households have typically lower replacement ratios than less affluent households. So basically, households that are, say, earning in the 50 to 80,000 range typically have a replacement ratio of 75%. So they need to spend, for every 100 cents that they spend pre-retirement, they're going to be spending about 75 cents once they retire. For the more affluent households that are earning more than $120,000 as income at retirement, the typical replacement ratio is going to be 55 to 65%. For our talk today, I'm going to do our example assuming this 55 to 65% replacement ratio, but certainly, that may vary by individual. There's another link here, which is something called the ICI, which is the Investment Company Institute Fact Book. This is a sort of industry-funded think tank that puts out a lot of research on investing products like mutual funds and ETFs and so on. And they part of the research that they do also talks about this replacement ratio. So if you click on this link, you can read more about the statistics about how much people end up spending in retirement relative to their pre-retirement income. For example, for our example today, I'm going to be using a number that's going to be in this 55 to 65% range. So having figured out that your replacement ratio, so how much you'll be spending if your pre-retirement income is something like, 55, 60, 65%, you then need to think about what will your pre-retirement income look like when you actually retire. Now, in order to do that, you have to think about adjusting your income for inflation, because if you're already retired, then it's not an issue. What you have is what you have. You're spending in today's dollars. If you're going to be retiring in 10 years, 20 years, 30 years, you should be thinking about projecting your income forward at the rate of inflation, because when you're saving, you're going to need to save for a future sort of nominal expenditure, not a future inflation adjusted expenditures. You have to think about what will your future nominal income look like. In order to evince it into that, you need to think a little bit about the rate of inflation. So let me just show you a picture. This is the year-over-year inflation rate in the US going back to the post-World War II period, like back to the mid to late 1940s. You can actually pull this chart on your own if you'd like. There's a wonderful website called FRED, which is put out by the St. Louis Federal Reserve Bank. And if you go on their website, you can download and plot many fascinating macro and financial data series. And one of the things you can plot is this rate of inflation. So if you kind of look at the broad outlines of what inflation has looked like in the US in the kind of the more recent era, there was a very high inflation 1970s. So this was like the 1970s oil shock, which by the late 70s, early 80s in the US, we had a rate of inflation that was running close to 15%. At about this time, we had Paul Volcker take over the chairmanship of the Federal Reserve, and he engaged in a very aggressive policy tightening program where they raised interest rates a lot and basically put the economy into recession to sort of to establish the Fed's inflation fighting credibility, which worked. And the rate of inflation by the mid to late 80s had fallen from a rate of close to 15% to something that was more in the 2.5% to 5% range. And since this time, since the early 80s, the rate of inflation in the US has been largely range bound between 2.5% and 5%. Of course, this little spike here that we had, this was like the post-COVID inflationary spike that we had in 2022, which in response to which the Federal Reserve raised interest rates. And of course, in 2022, we had a big market sell-off and bonds sold off, stocks sold off. So it was quite a messy time in financial markets. But what the Fed did, the restrictive monetary policy they followed since that time seems to have worked its way through the economy, and inflation is coming back down towards the Fed's 2% target inflation rate, which is what the Fed would like to see inflation in the long term. So in doing our financial analysis, I'm going to assume a rate of inflation will be equal to the average rate of inflation we've seen in the US since the mid-1980s, which is 2.8%. Maybe this is being a little bit overly conservative. Again, the Fed has a 2% inflation target, not a 2.8% inflation target, but we will, for our analysis, assume 2.8%. So having already thought about our replacement ratio, that we want to spend maybe 2/3 of our pre-retirement income upon retirement, and having thought about inflation of running somewhere between 2% to 3%, we're going to use a number at the high end of the range in our analysis. The next thing we need to do is think about what other benefits we'll be receiving outside of the spending that needs to come from our accumulated savings when we actually enter retirement. For most people, the majority of their for most, I would say, households in the US, the majority of their non-saving income will come from the Social Security benefits. So what do your Social Security benefits look like? Again, I give you links here. You can click. These numbers get updated periodically by the Social Security Administration. But the current projection is that in 2025, the average Social Security benefit received by an individual retiree in the US is about $2,000 per month. The maximum benefit that you can achieve in the US, if you retire at what is called the full retirement age, which would be 67 for people born after 1960 and a bit lower for people born before that. You can click on this link to see exactly what that full retirement age looks like. So the maximum benefit that you can have is about $4,000 a month. And that would go to people who have had, fairly high lifetime income. Like the more you've paid into the Social Security support fund, the more you will receive in benefits as of today's policy from Social Security. There are many other subtleties about Social Security income. For example, if God forbid a spouse dies, the surviving spouse, if they're not yet receiving Social Security, is entitled to receive the Social Security benefits of the spouse who passed away. So you can read more about some of these rules around Social Security on your own. But again, for our analysis, we're going to think of a number of Social Security income that's going to be something like $2,000 to $4,000 a month per person once they retire, and we're going to do our sort of financial projection using that number. Now, of course, if you worked at an employer that gives you a pension, then you would also include whatever pension you'll be receiving from your employer in the calculation that we're about to do, but we're going to assume there is no other benefit outside of the Social Security benefit. So here's the very simple, but I think fairly representative calculation that's going to give you a sense of how much you will be spending in retirement, how much you will be receiving from Social Security, and what the shortfall is going to look like. And once we figure out what that shortfall looks like, then we'll think about how much savings is needed to support that shortfall, and how, and the second part of our discussion, again, which chronologically comes first, is going to be how do we get to that level of savings once we figured out what it should look like. So here's a sample calculation that I wanted to go through. So I'm going to talk about a hypothetical working couple, sort of middle-class couple, that is jointly earning in today's dollars $125,000 a year. So we're thinking, a teacher and engineer, they live somewhere, I don't know, in Rhode Island, and this is their income. We're going to assume for our analysis 25 years until retirement, and we're going to use a rate of inflation, like I mentioned, of 2.8%. So how does the rate of inflation enter into this calculation? What we'd like to do for this analysis is to think about the income of this couple, not in today's dollars, but in terms of what their income will look like 25 years from today. The assumption we're going to make for this analysis is that both sets of the two people who part of this couple are not going to receive any raises at their job. They will only receive a cost of living adjustment every year that's going to increase their salary at that year's rate of inflation, which we'll assume to be 2.8% a year for 25 years. So if you grow $125,000 of income at 2.8% for 25 years, that's going to give you an income in 25 years in nominal dollar terms of $249,000. So that is the income that the couple is earning in the year prior to retirement. Now we're going to assume a replacement ratio because their income is above that $120,000 threshold that Fidelity thinks gets you to that 55 to 65% replacement ratio. We're going to use the high end of that number, of that range. So we're going to use a 65%, roughly 2/3 replacement ratio, which means that in order to maintain their lifestyle based on the statistics that has been collected by the asset management industry here in the US, this couple needs to be making 65% of 249, which is $162,000. So when they retire, they have to be making $162,000 a year in future dollars, in 2050 dollars. I guess that would be 25 years from today. And so the question is, how do they get there? So their target is 162,000. Now, I'm going to assume that each of them is going to be receiving $2,500 a month from Social Security income. So that's sort of, a little bit between average and the maximum that they can be getting. Again, average is 2,000, maximum is 4,000. So we'll assume 2,500. But by the way, I should mention, if you go to the Social Security website, which is ssa.gov, and you type in you register with the system, type in your Social Security number, your email, they'll send you a verification email, you click on it. It'll actually tell you what your projected Social Security income will look like depending on the age in which you retire. So you don't actually have to guess very much about what that number will look like. You can just log on to the Social Security Administration website, and they'll give you an estimate of what that number will look like. In our example, we're going to assume $5,000. So the $5,000 is a number that is in today's dollar terms. Again, we need to be thinking about this in 2050 dollars. So we're going to project forward this $5,000 of Social Security income, which should be in today's dollars, into dollars, that have accumulated at the rate of inflation for 25 years. So it's the same exercise we just did. We're going to effectively grow $5,000 a year for 25 years at a rate of 2.8% a year. And at the end of that time, that's going to give us roughly $10,000. So that's going to be the monthly income that the couple is making together when they retire. Multiply that by 12. And so our hypothetical retired couple, when they retire, are going to be entitled to $120,000 of Social Security income from the Social Security Administration. Now, of course, you may be thinking to yourself, well, what happens in 25 years? Is there going to be means testing? Like, will the Social Security fund run out of money at some point? We're going to assume all of these very important issues away for the purposes of our discussion here. We're going to assume Social Security will be well funded. We're going to assume there will not be means testing. Of course, all of these are policy decisions that will have yet to be made, but we're going to assume that the world in 25 years, in terms of Social Security benefits, will look as it does today. So of the $162,000 that we think this couple ought to have when they retire to maintain their lifestyle from working to retirement, $120,000 of those dollars will be provided to them by the Social Security Administration. So what is their shortfall? Their shortfall is going to be what they need to spend, the $162,000, minus the $120,000 that they're receiving from Social Security, which gives them a shortfall of $42,000. So going back to our sort of step-by-step decision tree for what happens in the decumulation phase, we've now thought about the replacement ratio, we've thought about the rate of inflation, we've thought about future Social Security benefits, and our sample calculation showed us that this hypothetical couple will need to spend $42,000 a year to maintain their lifestyle that they do not have coming from Social Security. So what do they do now? So the next part, of course, is to think about if you need to be getting $42,000 a year to finance your retirement, where will that money come from? And so there's a few options here. I want to mention some of them, but not dive into them too much because I want to focus on sort of the saving part of the picture. But one option for spending the $42,000 is to have enough in savings. And we'll talk about exactly how much you would need in savings in order to be able to spend $42,000 a year safely. So one option is to have enough in savings that every year you spend $42,000 from your savings. At the same time, you don't deplete your savings. Your savings will hopefully grow at something like the rate of inflation, for your entire very long and healthy, hopefully, retirement. And at the end of that, all of what is left of your savings is going to go on to your loved ones, and that will be sort of going to the future generation. So that is option one. The second option that many people pursue, and these are not mutually exclusive, you can do a little bit of each, is to think about buying an annuity. So I give you a link here to an article I wrote about a year ago for thinking about how to whether to annuitize or whether to spend out of savings. But the trade-off is going to look like this. If you buy an annuity, it will pay you a higher rate of interest than what you can withdraw from your savings without depleting your savings. So to put some numbers on it, what you'll see in a second is that what you have saved, you'll be able to spend about 3.5% to 4% of your savings every year without depleting your savings. If 3.5% and 4% or 4% of your savings is enough for you to provide for that shortfall that you won't be getting from Social Security, then that's great. That sort of solves the problem. You can spend out of savings, your money will be invested, and then in all likelihood, there will be a very large bequest that goes to your loved ones. But for people who don't have enough saved in order to spend 3.5% or 4% of their savings, that may not be enough. They can increase the percentage that they can spend by buying an annuity. So if depending on your age and your health and so on, you can think about the annuity income that you can get as being like 6.5%, 7%, like something in that range. So what's attractive about it is that it pays you almost twice as much as what you can safely withdraw from your own savings. So that's attractive because you don't need as much saved in order to spend the same $42,000 that we're going to use in our example. The negative about an annuity is that the way they typically work is if a couple buys an annuity, it will keep on paying as long as one of the spouses is still alive. So even if one person passes away, the surviving spouse will still receive the annuity benefits as long as they're alive. But when both people pass away, again, hopefully many, many years after they retire, the annuity goes away. And nothing goes to their loved ones. There's no bequest anymore. The annuity, whatever money has not been paid out, or whatever is left or whatever isn't left, is all then going to the insurance company. So I won't talk more about annuities here, but I just want to mention that for folks who need to have a higher spending rate out of savings than 3.5% or 4%, an annuity is an option. But the downside of the annuity is that the money then sort of disappears from the estate. I'll briefly mention another option. If you own your house or have equity in your house, there's something called a reverse mortgage, where people can take out money by effectively borrowing against their house, and then you don't pay you don't pay monthly payments, but the payments that you would have owed the bank for the interest on the mortgage basically just grows the principal amount of the mortgage. And that process sort of continues as long as you're alive, and you can use that money. But then when people pass away, effectively whatever the house is sold, whatever is needed to pay back that mortgage with all the accumulated interest is used to pay it back, and then whatever remains goes to their estate. Again, I won't talk more about it, but that is another option for getting liquidity for people who are retired. So what I want to focus the remaining of our discussion on is how much you can spend out of your wealth without depleting your wealth. So that's what I want to discuss for the next half hour of our time together. So the question becomes, if we're not going to annuitize and we're not thinking about doing like a reverse mortgage, how much savings do you need in order to generate $42,000, that $42,000 shortfall, to support this couple's, spending lifestyle when they retire? A useful rule of thumb in the investment industry is something called the 4% rule, which tells you that every year you can, sort of every year, but not quite. I'll give you a caveat. You can spend 4% of your savings, and that's sort of what you're spending every year. The way it actually typically works is you don't spend 4% of your savings every year. You when you retire, sort of spend in that first year 4% of what you have saved, and then you let that amount grow every year at the rate of inflation. So once you retire, you sort of lock in that initial spending target, and then regardless of whether your wealth goes up and down, you're just going to take whatever you started spending in the first year of retirement and make it grow at whatever the rate of inflation is, 2.5%, 3% a year, as long as for every year of your retirement. So the reason people came up with 4% is because roughly speaking, you can safely spend 4% of your start of retirement wealth at the beginning and then have it grow at the rate of inflation, basically for as many years as you are alive after you retire. What safely means is that the chance of running out of money is very low. Of course, you can never guarantee that anyone who's spending some fixed dollar amount every year will not run out of money, because who knows, the stock market may do crazy things. But you want the chance of running out of money to be quite low. You want there to be a very, very high probability that the couple, retired individual will not run out of money, even if they live for the next 40, 50, 60 years. And the second thing that safely means is that the wealth that remains in your estate after you've spent that fixed amount of annual spending should also sort of keep up with the rate of inflation. Because if you want to ultimately give a bequest to your loved ones, you would like to maintain kind of the real spending power of your money, which would mean that at least it should be growing at the rate of inflation, so inflation doesn't sort of eat away at the real purchasing power of that nest egg that's going to go on to your next generation. So the caveat here is that the 4% number relies on many assumptions, as you can imagine. Based on work we've done at Quant Street, we think that a 3.5% spending rule is better than a 4% spending rule, in the sense of it's a little bit more conservative. It gives you more margin of safety and a greater degree of confidence that you will not run out of money for the many, many decades that hopefully you get to live in retirement, and your wealth will still kind of grow at the rate of inflation. There's another caveat I should add to this. When you talk about a 3.5% spending rule, it can mean one of two things. And again, if you want to learn more about this, we can sort of talk about it offline, but let me just kind of briefly summarize what the issue is. If you fix a dollar amount at the beginning of retirement, say 3.5% of your retirement savings in the year that you retire, and then have that amount grow at the rate of inflation every year, the problem is that in a given year, if there's a big market sell-off, you're going to have to liquidate a larger fraction of your holdings in order to support that spending. A more conservative way to spend 3.5% is to make part of that spending variable. So for example, you could say that I'm going to fix 2.5% of my retirement savings and spend that as a fixed dollar amount growing at the rate of inflation for every year that I'm retired. In addition to that, every year of my retirement, I'm going to spend 1% of whatever is my start of year wealth, throughout my entire sort of retirement life journey. And the reason that's attractive is because in years when the market did poorly, or in years after years in which the market did poorly, you will be forced to spend less money because you're spending 1% of your sort of start of year savings, and it will automatically kind of force you to liquidate a smaller proportion of your savings in bad years. And having that little bit of flexibility in your spending rule of making part of it responsive to how the stock market's been doing, how your wealth has been, how your savings have been doing when they're invested in stocks, actually gives you a higher margin of safety that you'll be able to, sort of not deplete your money as you go through your retirement years. Okay, so as you get a sense here, there's a lot of subtle issues that need to be thought through when you're making these kind of financial plans. I'm giving you very broad sort of level discussion. You should talk to a financial advisor if you want, a deeper analysis, because there are many other, questions and considerations we're sort of leaving out. But in very broad terms, if we think the 3.5% spending rule is conservative, and we're targeting a $42,000 shortfall, then in order to finance that shortfall, if we're spending roughly 3.5% of our savings, in order to have enough savings to support the $42,000 of spending, when spending only 3.5% of your savings, you're going to need to have about $1.2 million saved when you retire. Why $1.2 million? Because 3.5% of the $1.2 million is equal to the $42,000 that is the shortfall from what you need to be spending at your replacement ratio of your pre-retirement income relative to what you're getting from your future Social Security benefits. Okay, so for our hypothetical working couple who has 25 years left into retirement, based on this analysis, we would conclude that they need to have $1.2 million saved when they retire. So they can spend 3.5% of that, 3.5% being sort of the safe spending rule, to generate the $42,000 shortfall that they will not be collecting from Social Security, that they need to basically support their lifestyle after they stop working. Okay, so we now return to the chronologically first part of our discussion, which is if we've now thought about what happens in the decumulation phase of this couple's life cycle, that they need the $42,000, which can be produced by $1.2 million of savings safely. The question is, how do you get to $1.2 million in retirement? Like, how do you actually go from where you are today to that $1.2 million savings in 25 years? So let me talk through the issues that are involved in this part of the discussion. So in order to get to the $1.2 million target, which seems, like a daunting amount of savings for some people, for many people, because it's a very big number, you need to figure out how much you need to be saving every year. I want to just quickly mention that when I say savings, I mean that you've already accounted for anticipated and unanticipated expenses that you might face, in your life. So, for example, anticipated expenses would be things like a car purchase, a down payment for a house, private school expenses, college expenses, wedding expenses, bar bat mitzvah expenses, all those kind of expenditures that people think they will have. Unanticipated expenses would be, like a tree falls in your garage, you need to spend, you need to spend kind of the deductible of your insurance policy, so in the tens of thousands of dollars to repair it, or maybe people will have to miss work for some family related reason and so on. So for these kind of expenses, the typical advice we give to our clients is people should have money put away in something very safe, like a treasury money market fund, or invested in US treasuries, or in a high yielding savings account that's FDIC insured in a bank somewhere. So I'm going to assume in the remaining discussion that the cash or this liquidity cushion that you need for these kind of anticipated and unanticipated expenses have already been taken care of. And we're now going to think about saving in excess of the amount of money that was put away for these sort of expenses. So we're assuming now the expenses are taken care of. Again, I'm being a bit cavalier because I'm skipping over a bunch of stuff that's quite important. But I will, we're gonna, for the interest of getting us all out of here by 8 o'clock, skip over some of the subtle issues. Okay, so there's a few things that are no-brainers in terms of how you should be investing and thinking about your investment portfolio. So the first thing that you have to think through in your investment plan is to take advantage of tax-efficient and employer-matched retirement planning vehicles. So what are some of these things? Of course, there's 401ks. 401ks are advantageous for two reasons. One is that the money that's invested in a 401k, any capital gains or dividend income that you receive on your 401k investments is not taxed. So, which is very advantageous because it's tax that you would have paid every year that you don't get to pay for 25 or 30 years, however much you have left until you retire and begin drawing down your 401k. And the capital gains taxes and dividend taxes that are not paid can stay invested, and you collect the return on what you would have otherwise paid as taxes. So that's very attractive. The second very attractive thing about 401ks is many of them have employer matches. So depending on the generosity of your employer, if you're investing in a 401k or a 403b, if you work for a nonprofit, your employer will often match, say for every dollar you put in, they'll match either 50 cents or depending on how generous they are, maybe 75 cents, maybe they'll match dollar for dollar every contribution you make to the 401k. So 401ks are very attractive savings vehicles that you should be taking advantage of if you can. Perhaps the most tax advantaged investment that you have access to is something called the Roth IRA. With a Roth IRA, you have to put in post-tax money. So with a 401k, you put in money before you pay taxes, but when you withdraw money from 401k, that money counts as income. So you pay income taxes on the 401k withdrawals in the future. So the taxes will get paid eventually. With a Roth IRA, you pay taxes now, but then you never pay taxes on it again. So you pay taxes, you invest in a Roth, any capital gains, any dividend income is never taxed. And that's extraordinarily beneficial. That's really very, very attractive, a very attractive investment vehicle. Unfortunately, the contribution you can make to Roth IRA is capped at $7,000 a year per person in 2025, and at $8,000 for those over 50. But in addition to that, you're not allowed to contribute to a Roth if your income is above, I forget the exact number, like something like 200,000 or so. Like if you're making more than that per year, you cannot contribute. You're not eligible to contribute to your Roth. But if you're making underneath the Roth contribution limit, putting money into a Roth is extraordinarily advantageous relative to just keeping your money invested in a non-Roth, like regular investment account, because the Roth, you don't pay capital gains and you don't pay dividend taxes, which is very attractive. So you would want to take advantage of 401k, 403b saving plans, employer match, the Roth if you're eligible. In addition to that, there's 529 college savings plan. So, probably most of you know, but if you can contribute to 529s on behalf of your kids. The money that goes in there counts as a gift. So when you contribute to 529, typically people make the annual contribution that's below the annual gift exemption, which is $18,000 per person per year. Actually, I think in 2025, it may have gone up to 19,000, but I know in 24 it was 18,000. And what's nice about 529 plans is the money also grows. The money has to be spent for college or graduate school expenses, but it grows capital gains tax and dividend tax free, which is terrific. And in some states, like New York, for example, the money that you put into a 529 actually can be deducted from your state income tax. And so there's an additional sort of tax benefit to putting money into a 529 plan. And finally, for those of you who will have estates that are above the, estate tax limit when it passes over to your loved ones, you have an annual $18,000 per person tax-free gift limit. So to the extent that you have someone that you'd like to give a gift to, you should also take advantage of that every year, because ultimately you can pass money tax-free to the next generation instead of keeping it in your estate and ultimately having to pay taxes on it. So of course, There are many more things that I am not mentioning here, but these are some of the very basic sort of building blocks of a financial plan that you would want to think about. Okay, so that's kind of taking advantage of the tax situation in the US. Now, from an investing point of view, when you think about your investment portfolio, you should think about very carefully diversification and liquidity. So let me just mention what I mean here. You should make sure that your portfolio is diversified across and within asset classes, which means you want to avoid concentrated exposures to individual issuers. So for example, if you want to invest in corporate bonds, you should not invest all of your corporate bond investments into a single corporate bond issued by IBM. You should spread that investment out across many, many different issuers to avoid the idiosyncratic risk of default by any particular issuer. If you're buying an annuity, you should think about buying an annuity maybe from multiple annuity providers, so you're not running a lot of counterparty risk to the one insurance company that you bought an annuity from. Maybe you want to buy an annuity from several companies, sort of to spread that counterparty risk across multiple annuity providers. In addition to thinking about diversification, you should think carefully about the upsides and downsides of illiquid investments like private equity, venture capital, or private real estate investing or private credit investing. On paper, a lot of private equity, kind of private credit, private real estate funds look quite good. But there are many caveats associated with a good performance. One of them being often individual investors don't have access to the same kind of quality deals that go into those statistics, because a lot of those deals are going to institutional investors, not individual investors. That's one thing to keep in mind. And the second thing to keep in mind is when you go into very illiquid investment vehicles, you may not be able to get your money out when you want to. So for example, you put in, $100,000 into some, private real estate fund, and you need the money, and if the economy isn't doing well and the year in which you need to withdraw the money, the sponsor of that fund can basically tell you, no, we're going to put up a gate and you're not allowed to take out your money, or you're only allowed to take out a portion of your money for the next several years, and you can't have access to all of it. So you have to think a lot, like long and hard, about whether private illiquid investments make sense for you, and perhaps they do make some sense for a portion of your portfolio, but you should then think about your liquidity needs and being able to access your investments when and if you need them, and make sure that you have other very liquid investments in your portfolio in case you're not able to access the illiquid ones. Like, for example, there's a very famous story of a kind of a Blackstone private real estate fund, which you can read about, for example, that in 2022 put up gates and wouldn't let people take their money out. For a lot of people, what makes good sense is to invest in low-cost exchange-traded funds or low-cost mutual funds. And when you do that, you should also make sure that the exchange-traded funds or mutual funds are broadly diversified across stocks. For example, VOO is a Vanguard very low-cost exchange-traded fund that invests in the S&P 500 index, and that you have exposure to bonds through a broad bond index. For example, there's an ETF called AG, which tracks the Bloomberg Aggregate Fixed Income Index in the US. Buying individual bonds, except treasuries, which are very liquid and behave almost like stocks, like very liquid stocks, buying individual bonds probably does not make sense for most people. Maybe there's exceptions to that here and there, but by and large, I think getting exposure through low-cost, highly diversified ETFs, exchange-traded funds, or mutual funds is probably the best path for most people. Okay, so to summarize sort of this part of the decision-making process, we've already thought about, we need the $42,000. We've thought about putting away some liquidity pool against anticipated expenses. So that's money we don't want invested in the stock market at all. You're taking advantage of your 401ks, your 403bs, your Roths, your 529 plans, and you have a diversified and liquid portfolio. The next thing you have to think about is, how should your portfolio be allocated? And here, what's really important is that you think carefully through the risk-return trade-off in your investments. And the best way I found to motivate what this trade-off looks like to people is to have them think about how big a loss are they willing to suffer in a given year without becoming a nervous wreck and not being able to sleep at night. So I think the sort of introspection people should do when they're deciding what their investment portfolio should look like has to revolve around the question, how much am I willing to lose in a given year? And still feel comfortable holding my investments as they were before and not feeling the need to sell out of my risky investments at exactly the worst time after they've experienced the major sell-off. So the way we like to approach this problem when we talk to our clients is we present to them the following table. Again, you can get it from this presentation, so you don't have to write down the numbers, but let me just briefly explain to you what it's doing. So this column is showing you how much of a hypothetical portfolio is going to be invested in the stock market. So this would be a 20% stock market investment. This would be all of the portfolios invested in stocks. And the next column is showing you what percentage of your portfolio is invested in the bond market. So they add up to 100%. So for example, if you have 60-40 would mean you have a portfolio that's 60% stocks, 40% bonds. 100-0 would mean that you have an all stock portfolio. Based on our analysis, and again, there are some assumptions that go into it, and you could repeat the analysis and get slightly different numbers, but to a first order approximation, over the last 30 years, if you had had a 100% stock portfolio, you would have had a return of about 11% a year. If you had had a 50-50 portfolio, your annual return would have been about 8%. So if you compare these two portfolios, who wouldn't want to be all in stocks? You would say, well, I can earn 8% a year in this 50-50 stock bond portfolio, or I could earn 11% a year in this all stock portfolio. So wouldn't I prefer 11%? That seems a lot better. That's true. However, the risk profile is quite different. So the rightmost column here, this set of numbers, is showing you the maximum historical drawdown of each of these portfolios over the last 30 years. So what does a drawdown mean? The drawdown is the peak to trough % loss of your investment portfolio when there's a big market correction. So the way to think about it is if at the peak of the market you had let's say you had $100,000 in savings, and then you had a drawdown of 26%, it means your $100,000 investment would have fallen by $26,000 and now be worth $74,000. So the drawdown of the maximum drawdown of a 50-50 half stock, half bond portfolio over the last 30 years has been 26%, which means $100,000 at the peak of that portfolio would have fallen to $74,000, would have fallen by $26,000 and then recovered, but over the next about 5 years, like 4 to 5 years, it would have taken to recover. So that's a drawdown of a 50-50 portfolio. What is a drawdown of a all stock portfolio? Well, the drawdown of an all stock portfolio was 50%, which means if you had been invested all in stocks, and it happened twice, it happens once during the dot-com bubble between 1999 and 2002. So there was a peak to trough loss there of 50%. And it happened the second time during the global financial crisis of 07 to 09. In both of those cases, a $100,000 investment at the peak would have fallen to a $50,000 investment at the trough and then recovered, but the recovery would have taken, depending on which of those two episodes, between 6 to 7 years. So when we talk to investors, we make sure to explain in great detail, and there's pictures here that I can show what these things actually look like, how long they last, but to get people to understand that by investing more in stocks, yes, you earn higher returns, but you also have this much higher potential drawdown that can be as high as 50%. And that's not a hypothetical. That actually has happened 2 times over the last 30 years in the US. So you have to then, use some introspection to think, well, given that these are the risk levels and given that this is the sort of trade-off that you face between return and drawdown risk, where are you comfortable in this risk spectrum? Again, it's a discussion you should be having with your wealth advisor. So having thought through all of these decisions, let's say you have now settled on a 70-30 portfolio. So you looked at those numbers, you decided, look, where I am in that return to risk trade-off, I'd like to have a 70% stock, 30% bond portfolio. And now we're going to do our assumed saving plan. Again, we need to get to $1.2 million upon retirement in 25 years for a hypothetical couple. That will support their $42,000 of annual spending. I'm going to assume that they start with $100,000 in savings and that they save $20,000 a year for 25 years. So the number you need to save every year is not $500,000, but it's $20,000, which for many people, is very hard. Like, it's hard to save for a couple making $125,000 in pre-tax income. It may be actually, it may be quite difficult to save $20,000, but that's basically what will be needed. So say you save $20,000 a year for 25 years. And I'm also going to assume that every year you start contributing $20,000, but every year you're going to grow your contribution at around the rate of inflation. So every year you contribute 2.5% more year after year after year to sort of keep to get your savings every year to keep up with inflation. So what ends up happening is, subject to some return assumptions about how stocks and bonds have done historically, which I'm not going to talk about now, but subject to these return assumptions, your portfolio grows. This $100,000 in 25 years grows to about $2 million a year. So that is great, because if you're saving $20,000 a year and it's growing at the historical average return of a 70-30 portfolio, then you end up with over $2 million, and that's it. Great, problem solved. However, what this analysis does not tell you is what happens if markets don't exhibit their average behavior every year. So this analysis ignores market uncertainty. And let me just try to graphically demonstrate to you what the impact of uncertainty is going to look like in your investment portfolio. So here is the average return of a 70-30 portfolio going back to the 1970s. On average, this portfolio returned 8.3% a year. And you can see how if you earned 8.3% every single year, a dollar invested in the 1970s would have grown in this incredibly smooth, exponentially growing way every year for the next 50 years. And it looks beautiful. However, that's not what the world actually looks like. What the investment actually looked like is the orange line. So the blue line is that an investment that returns 8.3% every year, year after year after year, and the orange line is what actually happened to the stock market. Now, they end up in the same place. So when you start here, both the orange line and the blue line end up at the same final wealth level. However, what really happened was you made more money than the blue line, and then there was a dot-com bubble. This was a 50% sell-off in the stock market. Then you made more money. Then there was a global financial crisis. Again, stocks lost 50%. Then you made more money. Then COVID hit, and the market lost like 30%, and then recovered all of it by the end of the year. But it lost, about 30% in 2020. Then the market recovered again. Then there was a 2022 sell-off. So the real world that we live in looks like this. Market stocks go up, they go down, they go up, they go down, and you have to plan for those fluctuations in your retirement plan. You can't just assume the average happens. Like, the average is too good of an assumption. You have to assume that markets move around a lot. So how do you take that into account? So the way we take that into account at QuantStreet when we do financial planning for our clients is we run simulations of the world. So we say, we're going to take a computer and we're going to simulate the world, simulate many, many outcomes of the world from now over the next 25 years. And we're going to look at all of those outcomes and not look at what happens on average, but look at what happens, in a good case outcome, in a bad case outcome, in a medium case outcome, like what happens across different possible outcomes in our simulation. So what the blue line is showing you is the simulation outcome that's better than 80% of all other simulated outcomes. So this is like the 1 in 5 best outcome. In the 1 in 5 best outcome, your initial $100,000, if you're saving $20,000 inflation adjusted every year, is going to become $2.8 million at the end of 25 years. So that would be a great outcome from a financial planning point of view. However, that's a good outcome. If you look at the 10% simulation outcome, that is the simulation so that 90% of all simulations are better and 10% are worse. So that's like the 1 in 10 bad case scenario. In the 1 in 10 bad case scenario, your wealth level would be at $1.2 million. So where does the $20,000 in savings come from? The $20,000 comes from planning for retiring in the 1 in 10 bad outcome. So you're not planning to save so that you're okay retiring if the average happens or if the 1 in 5 good outcome happens. You're planning to be okay in your retirement years if the 1 in 10 bad outcome happens. And if the 1 in 10 bad outcome happens and you're saving $20,000 inflation adjusted every year, that gets you to the $1.2 million target. So the takeaway from this is when you're thinking about savings, $20,000 is too much savings if you need to get to $1.2 million in 25 years if the average return happens every year. However, the average return, which is here the orange line, is actually a pretty good outcome. Many outcomes are worse than the average. For example, the 1 in 10 bad outcome is worse than the average. And when we talk to our clients and think about their financial plans, we try to make sure that the financial plans are robust to a fairly adverse outcome. So we'd like people to be saving enough money so that if the 1 in 10 bad outcome happens over the next 20, 30 years, that they're still going to be okay when they hit retirement, that they're going to, have enough that they can live comfortably off of their savings without depleting their savings. And look, if the world turns out better than the 1 in 10 bad case and you have too much money after 25 years, many people will help you solve the problem of having too much money, but not many people will help you solve the problem of not having enough money. So that's, as you're doing your financial plan, you probably want to think about, a fair amount of conservatism. So I'm a little over, so let me just conclude and summarize what I wanted to mention to you today. So financial planning for retirement should address, first of all, sort of starting at the end, how much money will you need to spend when you retire? Then you have to think about what's my safe annual spending out of savings, which ends up being like 3.5% to 4% a year. So that gives you a dollar number of how much you need in savings. And then you need to think about how should I be invested today in order to hit my savings target in 20 to 30 years when I retire. Along the way, you have to think about putting aside liquidity cushions for anticipated and unanticipated expenses. You have to think about taking full advantage of tax-efficient investments and gifting opportunities. And you should also construct a portfolio that's liquid and that if the market has a big sell-off, which it invariably will have at some point, that you're not taking on so much risk in your investment portfolio that you feel at the bottom of the market sell-off, I have to sell everything and move into cash. Because at that point, it's not a 6-year drawdown, it's a forever drawdown because you're not going to participate in the rally that's going to happen after the sell-off. And the way to mitigate that risk isn't, there's nothing you can do once the sell-off happens. The way to mitigate that risk is to make sure that you've planned for your own risk tolerance well ahead of time. So when that big sell-off actually comes, you're not scrambling to sell down your stock investments. You sort of just leave it alone, knowing that this was part of the plan all along, that to get that 9% annual return, you knew you needed to take on risk, and you took on an amount of risk that you were comfortable with. So as a final thing to mention, there's a link in this presentation which is called Do Your Research, and I give you links to some books and some other reading material, which I won't go over now, but you can look at it on your own. For those of you who want to work with a financial advisor, I give you here under suitable advice a set of questions you can ask your financial advisor basically to make sure they're giving you good advice. There is a website run by the SEC called the Investment Advisor Public Disclosure website, which allows you to look up a lot of information about any registered investment advisor in the US. They have to give large amounts of disclosure. You can see all of that information there. So you should do a lot of background checks on your investment advisor before you work with someone. And finally, if you want to talk to us at Quant Street, feel free to drop me an email. And if you don't want to drop me an email, my email is here, hmamaysky@quantstreetcapital.com. You can sign up for a newsletter here at bit.ly/quantstreet and then receive sort of monthly or sometimes twice a month letters from us to talk about all sorts of the kind of issues that I've been discussing today. So thank you for listening. I hope you stay warm.
Professor,
And,
there's one
it.
question in the chat box.
Okay, sure. Okay, yep. I don't see the question.
Social
when
security break even.
I see. Yeah, so I don't know of what is a good calculator for thinking about that. But the typical trade-off people face with Social Security is the longer you postpone taking Social Security income, the more you're going to get. I think if you retire, if you're born after 1960 and you've hit your maximum Social Security benefit, if you retire at 67, you're going to make $4,000 a year. If you retire at 72, you're going to make $5,000 a year. So I think at that point, the calculation really depends on, your health and your life expectancy. So if you're a healthy individual and, hopefully you live until you're 100, then it probably makes really good sense to wait until 72 because you're going to earn that additional $1,000 a month for 30 years. But I think a lot of it depends on your life expectancy and your health and sort of your general well-being in terms of that decision. So I don't know an exact website to point you to, but I think that the main consideration is what I mentioned. And by the way, don't quote me on the numbers. I think the numbers I mentioned are correct, but double check. I give you links in the presentation to go to the Social Security website to see it 67, 72, 4,000, 5,000. You can just verify that those numbers, but I think as ballpark numbers, I think they're about correct.
Okay, thank you very much. Very informative. I learned a lot. Thank you.
Well, great.
Yeah,
Thank you.
and yeah, I sent you a message